Hello, welcome to Chapter 8, Valuation of Inventories, Cost-Based Approach. So in this chapter, we'll be looking at some inventory issues, common inventory issues for corporations, classification, cost flow, control, how inventory affects cost of goods sold, what goods and costs should be included in inventory, some cost flow assumptions, so you should be probably somewhat familiar with average cost, FIFO, LIFO. And then we'll look at some special issues, LIFO reserve, LIFO liquidation, dollar value LIFO, comparison of LIFO approaches, and then some advantages and disadvantages of using LIFO, and why it is used by the majority of the time by corporations as the basis of selection. Then we'll look a little bit at the inventory errors, if ending inventory is misstated or if purchases and inventory are misstated, how does that affect our financial statements. So inventories are an asset, and they're normally a current asset, right? They're held for sale in the ordinary course of business, or they can be goods used in the production of goods to be sold. All right, so businesses with inventory typically would be a merchandiser or a manufacturer. Service entity may have supplies, but they usually do not have inventories. All right, so classification of inventory. A merchandiser normally just have one inventory account, and they purchase merchandise ready to sell. So Walmart is an example here, and that's a good example, but any other retailer is someone that just buys inventory to sell. So grocery stores and clothing stores and department stores would all be considered merchandisers with one inventory account called inventories. On the other hand, if we have a manufacturer, they're normally going to have three inventory accounts: raw materials, work in process, and finished goods. So raw materials are materials that we buy to convert into work in process. Work in process are goods that are partially complete, and then finished goods are goods that are ready to sell. All right, so for a merchandising company, they purchase inventory. They may debit purchases, credit accounts payable. When it's sold, they'll debit cost of goods sold, credit inventory. All right, and so the cost of goods sold account, of course, would be increased, and the merchandise inventory account would be decreased. If you're using, by the way, if you're using a perpetual inventory system, when you buy inventory, merchandise inventory, you would debit inventory and credit accounts payable. Then when it's sold, you would debit cost of goods sold and credit inventory. All right, so two systems that we use, I just mentioned it, perpetual and periodic system. Perpetual inventory system was used less before computers because it's more complex, but nowadays most companies use perpetual systems because it's easy with programs like QuickBooks and other programs that it's easy to keep track of that inventory. So under a perpetual inventory, anytime I buy merchandise, I'm going to debit inventory, probably credit cash or accounts payable. Freight in, that's if we pay for freight, that would also be debited to inventory. Purchase returns, if we have any of those, purchase allowances and purchase discounts would be credited to inventory. Once I sell my units, I'm going to debit cost of goods sold and credit inventory. My subsidiary ledger for inventory would show the quantity and cost of each type of inventory that is currently on hand. In a periodic system, we determine ending inventory by physical count. So purchases of merchandise are always debited to purchases, probably credit accounts payable or cash. Ending inventory is then determined by a physical count. So I can calculate cost of goods sold simply by taking my beginning inventory plus purchases and subtracting that 125,000, which I would find by counting the inventory. All right, so assume at the end of the period, the perpetual account reported has an inventory balance of 4,000. But then we do a physical count and we only find $3,800 of inventory on hand. So what I would need to do here is debit account called inventory over and short, sometimes called inventory short and over. In this case, I'm short, so the account is debited and inventory will be credited or reduced by 200. All right. So that amount, the inventory over and short, is really a contra account to cost of goods sold. All right, so all companies, of course, need periodic verification of their inventory records by counting the inventory, by weighing it, by measuring it. With new technology and blockchain, I think there's going to be some big technological advantages. There already are. People use RFID and barcode technology to count their inventory. And so once I count the inventory, I've got a physical count of my inventory. I want to compare that with the detailed inventory records. And if there's a difference, in, as I showed before, we'd possibly, we'd make an entry to inventory short and over. A company should take physical inventory at the end of the year, properly report the inventory quantities in their annual accounting reports. Now, that's not really a requirement for companies to count their inventory, but it is a requirement for their auditors. If they have a publicly held company, they have a CPA firm, the auditors must, not all the inventory, but must count a portion of that inventory. But in reality, companies also will count their own inventory, and they're going to compare it with what's in the records so that they have reasonable assurance that the records are accurate. Cost of goods sold. So you must allocate, all the goods available for sale. So beginning inventory plus purchases. So that's goods available. So that must be allocated between ending inventory and cost of goods sold. So if $200,000 in ending inventory, then the rest of that must be cost of goods sold. All right, so goods included in inventory. The company will recognize their inventory and accounts payable at the time it controls the asset. So when do we include goods in the inventory? So normally it's passive title, and that's used to determine control because rights and obligations are normally established legally. So for instance, FOB shipping point, that means that the buyer is paying for the freight. So if the buyer is paying for the freight, normally ownership is going to pass title to the buyer when the goods are delivered to the carrier. So when the goods are loaded onto the carrier's van. On the other hand, seller will pay the freight cost over here, right, when ownership passes to the buyer. Because if the seller is paying for the freight costs, then the seller will own the goods and has control of the goods as the goods are in transit. Once the goods are no longer in transit and they're at the buyer's place of business, ownership will then pass. Title to the goods will then pass to the buyer. All right, so a little later here. So if the seller is paying for the goods, the seller has control of the goods while the goods are in transit. If the buyer is paying for the goods, then the buyer has control of the goods while they're in transit, and normally the goods will be, or title will be changed as soon as the goods make it onto the truck. Sometimes you might see consigned goods, and you've probably been to consignment shops. The consignment shop does not own those goods. Someone comes in, brings in some goods, sell these for $100, and they'll say, okay, we'll do that for you, but since we're doing all this paperwork and so forth, we want 20% of the proceeds. But if inventory, the $100 worth of inventory is brought into the shop, that does nothing to the consignee's inventory. It does not increase their inventory. If they're dealing with consignment sales, they're just interested in fee revenue from those consignment sales. So no entry is made to inventory if goods are on consignment. If I'm bringing in goods to some shop, baby clothes, $100 worth of baby clothes, they're not going to make an entry in their inventory account for baby clothes. Okay, so I'd make an entry for inventory. Once I sell the inventory, it would be reduced. Me, the owner of the baby clothes. If the owner of the store is just interested in the fees I'm going to pay him, I'm going to say, I'll pay you 20% for doing this for me. So anytime we sell some of these clothes, you get 20% as the consignor. All right, sometimes we have sales with a repurchase agreement. We have to be careful with these. Sometimes it's a product financing. There's a famous case where Enron sold a barge, if you can believe this. Enron sold a barge to Merrill Lynch. Merrill Lynch held on to the barge for 5 months after the December 31st date and then sold the barge back to Enron. Why Enron had a barge, why Merrill Lynch had a barge, did not make a lot of sense. But we would sometimes call those sham transactions, or sometimes called parking transactions. That's what Enron was doing. They were parking that barge for 5 months. They wanted it off their balance sheet. Once December 31st passed, then they bought it back from Merrill Lynch. All right, so that's really not a good transaction. It's not a transaction at arm's length. All right, and normally we're not going to be able, or we should not, recognize revenue. Merrill Lynch should not have recognized revenue for, Enron. Enron should not have recognized revenue for selling the barge for 5 months to Merrill Lynch. All right, special sales agreements. You might have a sale with a very high rate of return. So we'll record the sales revenue at the amount we expect to receive from that transaction. Normally we'll establish an estimated inventory return account at the date of sale to recognize that some of the inventory will be returned. So when we talk about high rate of return, sales returns are high. So in this case, you have 10% of your sales. I know it's wrong at your quality, but 10% of your sales are being returned, then you're normally going to have to probably be required by your auditor to set up some kind of allowance account for that sale. All right, costs including inventory product costs. So those are costs directly connected with bringing the goods to the buyer's place of business and converting such goods to a saleable condition, right? So that would be if you're buying merchandise to sell, be the cost of the merchandise, plus any costs that you had to get, to promote the item, to package it a little bit differently. Those costs would also be included as product costs. Period costs are not included in inventory, and those are generally selling, general, and administrative expenses. Treatment of purchase discounts, we can use either the gross method or the net method, or both GAAP-based. The purchase net method is basically you're saying, I'm taking all discounts. So record your inventory at the discounted amount. Gross method is you have a 2% discount that you might get. We don't know if we're going to take that or not, but with the gross method, we would record the discount when we take the discount. So the net method, record the discount as soon as you buy the item, record the inventory at a lesser price. And then if we have any discounts that we don't take, we'll have a discounts loss account, which is kind of like a performance measurement account. All right, so which cost assumptions should we adopt? Specific identification, that's usually used by companies with very little inventory, and it's very easy to identify cost of the inventory. So a good example of a company using specific identification would be a diamond retailer, someone selling diamond rings. We know they're expensive. There's not a whole lot of diamond rings in the jewelry store, so we can specifically identify when we bought it and what we paid for it, and of course what we sell it for. All right, so that's specific identification. That's the most accurate approach to costing your inventory. It's basically the inventory, and we identify which inventories we paid for, how much we paid for those specific inventories. Other approaches are FIFO, LIFO, and average cost. And what's interesting is that you may use FIFO. That doesn't mean that your inventory has to be first in, first out. Or it does not need, in order to be GAAP, does not need to be consistent. It's helpful. I think it's probably, if FIFO, if that's what cost flows are, first in, first out, then we probably should use that. But it's not required. It does not need to be consistent with the physical movement of goods. Goods might be FIFO, but the physical movement of the goods might be closer to LIFO than FIFO. All right. So CalMart had the following transactions. First month of operations. All right, we need to compute their goods available. So our beginning inventory was March 2, 2,000 times 4. And then I had two purchases. A purchase on March 15th, 6,000 times 440. And then a purchase on March 30th, 2,000 times 475. And then we sold 4,000 units. So my total goods available for sale are these three lines: 2,000 times 4, 6,000 times 440, and 2,000 times 475. All right, specific identification, talked about this earlier. Includes in cost of goods sold the costs of the specific items sold, used when looking at very few transactions, and they're costly, easily distinguishable, like diamond rings, engagement rings. We match actual costs against actual revenue, or matching principle. Cost flow matches the physical flow of goods. It may allow a company to manipulate net income using the specific identification approach. Okay, if you're not being forthright with the numbers and so forth, that maybe you record a specific identification to the wrong sale. So I'll have a higher gross margin. Average cost. So that's just the average cost of all inventory available during the period. It's harder to manipulate income with this one. But measuring a specific physical flow of inventory might be very difficult. So the average cost advantage is, well, I can't measure that physical flow of inventory. I don't really know if it's first in, first out, or last in, first out. So I use average cost as kind of, well, maybe some of it's LIFO and some of it's FIFO, so I use it kind of as a buffer. First in, first out, so goods are used in the order of the purchase. So goods used first, purchased first, are used first. So it does, or should, approximate physical flow of goods. Any inventory should be close to current cost. It does fail to measure current costs against current revenues because you're using first in. More current costs, of course, will be those last in costs, particularly if we're in a period of inflation. And then LIFO, the LIFO reserve, we'll talk a little bit about this in the next slide, but it's for tax and external financial reporting purposes. FIFO and average cost standard cost system are used for internal reporting. So LIFO we can use for tax and external financial reporting. The other methods, FIFO, average cost, or standard cost systems, can be used for internal reporting purposes. The reason why we have a LIFO reserve for pricing, easier record keeping, for bonus arrangements, profit sharing. LIFO can be troublesome, the negative, for interim periods. So let's talk a little bit more about this LIFO reserve. So it's a difference between the inventory method used for internal reporting purposes and LIFO. So Acme Boat Company uses FIFO for internal reporting, but LIFO for external reporting. At January 1, 2017, the allowance to reduce inventory to LIFO balance is 20,000. December 31st, 2017, the balance should be 50,000. So we do a count of the inventory, it should be 50,000. As a result, we realize a LIFO effect and make the following entry at year end: will debit cost of goods sold for 30,000 and credit allowance to reduce inventory to LIFO for 30,000. All right, so that difference, that 50,000, that correct balance, and the 20,000, which is in the allowance, would be charged then to cost of goods sold. Would have to be increased by 30,000, and then we could increase the allowance by 30,000. All right, special issues related to LIFO. So companies should disclose either the LIFO reserve or replacement cost of inventory. Here it tells us that inventory is valued at lower cost market. That's your replacement. Is it lower of cost or market? What's going to cost us the market cost? So it's going to cost us to replace it. So that's what they've done here, is they've shown the replacement. All right, then they note that if the FIFO method had been used, inventories would have been $11,000 higher in the current year and $13,424 higher in the previous year. Okay, so that we're noticing, or that we're putting in to tell our user of the statements. Basically we would add 11,700 higher inventory if we use FIFO. All right, LIFO liquidation. Older, lower cost inventory is sold, resulting in lower cost of goods sold, higher net income, and higher taxes. So the specific goods approach to costing LIFO inventories might be unrealistic. One, accounting cost of tracking each item like you would under specific identification is expensive. Erosion of LIFO inventory can easily occur. We call that LIFO liquidation. We're eroding our levels of inventory. Can occur, and that may distort net income and lead to a substantial tax payment. So here's an example of a LIFO liquidation. I got a Bassler company has 30,000 pounds of steel in inventory. With cost determined on specific goods LIFO approach. So that's what these amounts are. So that 205,000 would be specific goods LIFO approach. But at the end of 2018, only 6,000 pounds of steel remain in inventory. So I've liquidated all my inventory levels back to 2014. All right, so only 6,000 pounds of steel remain. Okay, and so only 6,000 pounds of steel remain in inventory, and that's shown by the fact that we had 5, 12, 22. We had 4 base layers. So what's happening here is that we've gone down, with all this inventory we've sold, we've gone down to our 2014 base level that we sold 2,000 of this 8,000 units that from that base. We had 8,000 units left, theoretically. 8,000 units left from the 2014 base. We've sold 6,000. We've sold all our inventory, but 6,000 units. So we've liquidated all these layers, which is known as the LIFO liquidation. All right, another issue related to LIFO is dollar value LIFO, and increases and decreases in a pool are measured in terms of total dollar value rather than the physical quantity of the goods. So we can have a broader range of goods in a pool. We can put goods in that we may not be able to, they're not like the other inventory items we're selling. Permits replacement of goods that are similar, helps protect LIFO layers from enrollment. From erosion. From erosion. All right, so here's an example. So the base year is this year, the base year is 2014. We have inventory 20,000, multiply it by 100, so 200,000. That's our base year. The other years you're going to divide 299 by 115, 300 by 120, and 351 by 130, and that's how you get these results here, the 260, the 250, and the 270. Right now, this is going to look ugly. we're going to compute the ending inventory under dollar value LIFO. So the base year, it's actually we have no LIFO reserve. We have $200,000 of inventory. And no reserve because the inventory year-end prices, 200,000, is the same as the LIFO amount of 200,000. So there's no difference between this first column and sixth column, value of LIFO. They're both 200,000. All right, then year 2, we have 299 divided by 1.15, so we got 260 is the inventory at base year. Base year is 1.15. So we got 260,000 of inventory at base year prices. Total value of LIFO, total value under LIFO is 269. The 200,000 plus 60,000 times 1.15. All right, so my total dollar value of LIFO is 269. Over here, though, inventory is 299. So we've got a $30,000 reserve for this inventory. Same thing for 2016. For 2016, I've got 200,000, which would be my dollar value of my LIFO. And then I had an additional 50,000 at 1.15, which was 57,500. All right, so I add those two together, 257,500, and then I can subtract my year-end prices of 300, and I end up with 42,500. All right, and then finally, the last one, I've got 3 layers. Got the 200 base, so we never hit that. By the way, the reason why we had 2 layers here, and one was for 260, is that we burned through this whole layer. So that layer does not exist anymore, that 60,000 layer. We burned through that, so we don't see it here. All right. And then the 50,000, I've got that for 2016. So I'll multiply that by 1.15, I got 57.5 for that one. Okay, so, and here, by the way, we have for 2016, we have an index of 1.12. Okay, but the amount of inventory end of the year is based on $200,000 amount in base year prices, and then the 50,000. So we're assuming that we burn through the rest of that and recorded at 1.20. All right, then the last year, 2017, I have 3 layers at original 200,000, the 50,000, 1.15 here, and then the 20,000 times 1.13. Right? The new index is 1.13, and 20,000. Multiply that by 1.13 gives you the 26,000. All right, so that 20,000 then is in that last I'm sorry, it's in that last, we call level. It's in that last level. So it has 3 different levels. So 1.3, we have 20,000 left of that. So we haven't, not been a good year for sales, I guess. So we haven't sold anything in the 50 or the 200, but we have burned most of this level for the 1.3 level of the 3.5 and the 270 at base year prices. Well, 273 base years, right? The 200 from 2014, 50,000 from 2015, and then 20,000 from 2017. Most companies use consumer price index for consumers when selecting a price index. These price indexes here, we can use CPI. Some special issues can be expensive due to this approach of specific LIFO costing. Can be expensive to get those numbers. Expensive and time consuming. Specific goods pooled approach is another one that's used. This reduces record keeping and clerical, more difficult to erode the layers. Using quantities as measurement bases can lead to untimely LIFO liquidations. Dollar value LIFO is used by many companies, probably the majority. All right, a few more special issues. Matching principal, tax benefits, improved cash flow, future earnings hedges, retained earnings, inventory, understanding inventory, physical flow of inventory, and then involuntary liquidation, poor buying habits are some of the major disadvantages you would have to LIFO. So LIFO is generally preferred if we have a period of inflation, selling revenue is increasing faster than cost, or if the company is a fairly constant base stock. So if our 80,000 that we purchase every year, we sell 78,000 of it to 80,000. LIFO is not appropriate where prices tend to lag behind costs, so it might take longer. Prices tend to lag behind costs. LIFO is not appropriate. So the prices aren't changing as fast as your costs are changing. All right, it's not appropriate if specific identification is traditionally used, would normally be more accurate, or where unit costs tend to decrease as production increases. Switching from FIFO to LIFO usually results in a good tax benefit right away. Concern about reduced income resulting from the adoption of LIFO has less substance now because IRS has relaxed the LIFO conformity rule, so financial statements and tax list rule had to have the same inventory flow. Not true anymore. So financial statement and tax returns required to have the same inventory flow back in the day, not anymore. All right. And then we can let's take a look at inventory errors. So a lot of times the inventory error in inventory will be counterbalanced in the next year, but the income statement will probably be misstated. The beginning and ending inventory will probably be misstated. So here's a quick example. Jay Weissman understates the inventory by 10,000 in 2016. So it's going to make it overstated in 2017. All right, so, well, actually, it's not overstated, but that is the correct number in 2017. So if incorrect, it's lower. 10,000 should be 20,000. In 2016, the actual amount should be 20,000, and the correct amount should be 10,000 for income. So notice income 30,000 here, 30,000 here is going to be the same over 2 years. So that was just with inventory. That's just inventory being misstated. We could misstate both purchases and inventory. So in that case, cost of goods sold net income will not be under or overstated because does not net income and cost of goods sold, there will be no effect on those items. And that's because those errors will offset one another. All right, and then assume, this just shows you that hey, we had understated accounts payable, understated ending inventory. How does it affect things? Well, if I do my balance sheet formula calculation for current ratio, know that current assets divided by current liabilities with these numbers is a 3. So it's 3 to 1. We have 3 times as many current asset we have 3 times as much current assets than current liabilities if inventory is understated. If we corrected it, though, notice that the current ratio is only 2. So these ratios, ratios that are sometimes used for measuring performance, might be out of whack. And so we want to be very careful with how we use that information. All right, if you have any questions, you can give me a call. Enjoyed it again, so have a good week. All right, so there's a number if you need to give me a call.